All right. Good morning, everybody. My name is Kwame Owino, and I work as the Chief Executive Officer of the Institute of Economic Affairs. The IEA is a think tank, and we carry out research on important issues regarding Kenya's economy. And we use those for, one, public education, such as a session such as this, to use that for intervention and discussions with policymakers, but more importantly, just to expand dialogue and to infuse that into dialogue to inform more the generation of more policy of alternatives. Now, anybody who lives in Kenya knows, for instance, that in the last 1 year or so, we've had unprecedented high levels of inflation. Obviously, some of it is driven by factors outside Kenya's control. But if you're a student of economics, one of the things we understand is that inflation in Kenya tends to be driven generally by two things: food prices and energy prices, especially crude petroleum, for which Kenya does not have sufficient local reserves and therefore imports from the global market. If the import of petroleum comes at the same time as a shock on the Kenya shilling, such as what we've seen, then the prices of petroleum tend to go up. And so in the last few months, one of the things that Kenyans have experienced is rising energy prices, not as much now as it was towards the end of last year, rising energy prices and rising food prices, and that has driven inflation. On the other hand, if you look at the reserves, on foreign exchange reserves, they've been dwindling relative to other areas. So yes, it's still within the required level of 4 months of export cover, but it's barely there. So when the convergence of those factors takes place, I think it's been clear that energy procurement, and especially its buying it at international levels, has been a bit of a problem for, let me say, a challenge for private sector firms that do the imports. Now, the new administration over the last 2 months have announced a plan meant to cushion and actually to stop, or rather to ameliorate this situation by going into a direct agreement with some countries in the Gulf. I thought it was Saudi Arabia and the UAE, but we'll learn about that. So our purpose today is to have the sector regulator who's right on the forefront of these policy choices. And we have the Director General of the Energy and Petroleum Regulatory Authority, who will be speaking to us about what the details, the objectives and the rationale of this agreement that the government of Kenya concluded with some countries in the Gulf, and actually to provide further details to allow us to have a conversation, a meaningful conversation. So our intent today is just to let us know this has been covered in the press, but to just get and to complete the circle by asking ourselves, what is the problem as was identified? What is being solved? What's the duration of this? And when do we expect? How do we observe to see whether these policy choices we made will have the effect? So we are privileged to have the Director General of the Energy, Petroleum and Regulatory Authority, Daniel Kiptoo Bagoria. Daniel has vast experience in the energy and petroleum sectors with a bias in policy formulation, regulation and project and structured finance. He previously served as a legal advisor at the Ministry of Energy and State Department of Petroleum, and was the chairman of government's Fast Oil Committee, charged with delivery of fast oil for Kenya. He was also instrumental in the drafting of the Energy Act of 2019 and the Petroleum Act of 2019 as well. Daniel is a certified public secretary in Kenya, CPS. He's also a chartered secretary in the Institute of Chartered Secretaries and Administrators in the in the UK, ICSA, and a member of the Association of International Petroleum Negotiators. He holds a master's degree in petroleum law and policy from the University of Dundee, Scotland. So Daniel will make a presentation, but I'd just like to advise our audience, please keep your microphones muted, and at the same time, keep your cameras switched off as well, so that Daniel can give us a presentation. Thereafter, I'll hand over to my colleague, Fiona Kadia, who's an assistant program officer in our our economic regulation program, to handle the plenary. So welcome, Daniel. We'd also like to let all our guests know that we record this session, and we only record it for the purposes of just providing an archive and a possibility for those who are not able to sit in at this moment to follow it up. So please be alerted about that. So I'd like to welcome Daniel to go ahead with the presentation. Welcome, Daniel. Please switch on your microphone and your camera. Thank you very much.
Thank you, Kwame, and good morning, everyone. Quite happy to be here today to have an engagement with you on first, generally on our mandate as a regulator, and second, on the petroleum pricing framework in this country. I'll first start, and I will not be making a presentation because I thought it would be best to have more engagement in terms of bilateral engagement, Q&A, and clarify a lot of the issues with respect to our mandate and also with respect to the G2G importation of petroleum products into this country. I'll first start by saying that for us as a regulator, we are charged under the Energy Act of 2019 with both the technical and the economic regulation of the electricity and the petroleum subsectors. So from an electricity front, we do regulate both. From electricity front, we do regulate the entire value chain, starting from generation through to transmission, to distribution and to retail. And on the petroleum front, we regulate upstream petroleum, midstream and downstream. So on the upstream front, this is a mandate that has been given to this authority as a shift from previously where the ministry used to regulate upstream petroleum. We also now continue to regulate midstream and downstream petroleum as well. As you may be aware, in Kenya, we do operate in a price-regulated environment. We are more famously or infamously known for our actions, our decisions when it comes to the 14th of each month, because we determine the maximum applicable prices for petroleum products in this country on the 14th, what will be applicable between the 15th and the 14th of the next month. With respect to petroleum, I think we need to start first from the standpoint that Kwame had mentioned, is that we are in an energy crisis at a global front. We're also looking at a global economy that is fighting recession. And this is not a situation that was really expected when we came out of COVID. During COVID, we saw very low energy prices. For instance, in the shales in North America, we are seeing negative prices because the cost of shutting down production would be more expensive or more detrimental to the upstream companies as opposed to getting somebody to lift their production. We saw very low oil prices even at the pump at the time during at the height of COVID. We had our petroleum pump prices hitting below 70 shillings per litre, but really we didn't see a lot of this being reflected in the market because there was a significant economic slowdown, there was lockdown, and we then came out of COVID and the markets rebalanced and reopened quite fast. It was not anticipated that we would be in this challenge. Then come mid of 2020, when we saw the conflict between Russia and Ukraine begin. When that began, we were playing it by ear as a regulator. We were engaging with the policymakers at the Ministry of Petroleum and Mining at the time and the National Treasury to see how this will impact our market, recognizing our price-regulated environment. In terms of the petroleum pricing and the petroleum pricing regulations that we do have in force, the biggest component when it comes to the impact of the petroleum prices in this country is the landed cost. The landed cost is not something that is within our control as a country. What is within our control or within our gift are matters with respect to the cost of transportation, the cost of primary and secondary storage in country, the margins due to the oil marketers, and the levies and taxes. When we did see a significant challenge as a result of the energy crisis globally with the increase in the landed cost of petroleum products in the country. And this coupled with the fact that we were starting to see a strain on availability of the greenback in the country. There was a decision taken at policy level from the government to introduce a price stabilization program. And this was on the backdrop of an amendment of the Petroleum Development Levy that was increased from 40 cents to 5 shillings and 40 cents. The thinking of the stabilization fund, and it's important that I say this, that this was a stabilization fund, not a subsidy. The thinking is that would be able then to pool funds together in this fund for use on a rainy day. At the time when we were able to introduce this in the mid of 2020, we were in a very low oil price environment with respect to crude and also petroleum products. This gave us an opportunity to be able then to increase the levy so that then we could be able to save something for a rainy day. But at the time, nobody was of was in the know that would be where we are with respect to recession, with respect to the high oil price environment on account of the challenges with Russia and Ukraine. This levy collects about close to 2 billion shillings a month. When we did start the stabilization program, the government was spending slightly over 500 million shillings to stabilize pump prices in the start of August 2020, around August 2020. Let me leave it at that. When this problem persisted, we then saw these numbers rising. At the height of it, in mid-2021, the value of petroleum products imported into this country was hitting close to the $1 billion mark, close to $900 million. Today, on average, our import bill is about $500 million a month to $550 million a month, and this accounts to about a third of our import bill as a country. This situation was further made worse by the challenges with the tightening of monetary policy in the US out of the COVID pandemic, which we continue to see today. And this led to challenges with respect to liquidity. The challenge that we did have, and I think we just want to put this out there, that in the run-up to the general election, the main imperative for us as the regulator and also from government from a policy standpoint was security of supply. And I think this continues to be our primary imperative as a regulator, is to ensure that, one, we keep the lights on in terms of our mandate with respect to regulating electricity, and two, we ensure that we keep our vehicles on the road and we continue to drive our economy through ensuring that there's security of supply of petroleum products. We then had this convergence of a high oil price environment internationally and the challenge with respect to availability of dollar to be able to pay for product. The current regime, which is the open tender system, is a system which is private sector driven, but superintended over by the ministry responsible for petroleum and us as the regulator. Where the oil marketing companies come together and put together the import requirements, not only for the country, but for the region. They are then able to then call for imports through a process which is, as I said, superintended over by the ministry, but you then have Kenya Pipeline Company sitting with the oil marketing companies and coming up through a committee called the Vessel Scheduling Committee and the Supply Coordination Committee, which is a committee of industry, the ministry, and regulated by us, where we'll be able to come up with the requirements for product on an M+2 basis, because we plan on a 2 months ahead basis and we procure on a 2 months ahead basis. We then have on average about 8 cargoes that we import into this country. We have about 4 cargoes of about 85,000 metric tons of AGO, which is diesel grade of petrol, that is imported to the country on a monthly basis. We have 3 cargoes of PMS, which is premium motor spirit, super as we call it. And we have 1 cargo of dual purpose kerosene, which is the jet fuel and the kerosene that is used, about 10 million liters. Is a small number. We then go ahead and the industry then calls for tenders for 8 cargoes. And on these 8 cargoes, the oil marketing companies that are licensed by us to import petroleum products in the country are eligible to participate, and they participate in 2 ways. They could participate as a seller into the OTS, or they could participate as a buyer. So whoever wins the tender then has the opportunity to import the products on behalf of all the other oil marketing companies. And then this is then shared to them on the basis of their throughput. KPC on a quarter by quarter analyzes the throughput and your ability to lift as an oil marketing company product out of their system. And you then get an allocation commensurate with your ability to lift product based on the last 3 months. This is a system that has worked and has worked quite well for this country and has also been emulated by a lot of countries, not only in the region, but further beyond. And it's a system that has worked. But because of the challenge with respect to dollar availability and also the high oil price, there was a thinking that we need to look at how are we able to use petroleum, accounting to a third of our petroleum revenues, to help us solve this macroeconomic problem. The thinking was to introduce a duality where we could be able to solve our short-term problem through entering into a government-to-government arrangement, which will allow us then to buy us some time, to allow some reprieve for us to be able to weather the storm, as it were. The thinking then was actualized through a government in March this year entering into a master framework agreement with the 3 oil companies, 2 from the Emirates and the Saudi Aramco, which is a state-owned company of the Saudi Arabian Kingdom. This agreement, the master framework agreement, as I said previously, is that the open tender system is a market-driven arrangement. The government only superintends, and we as a regulator regulate. We then entered into this master framework agreement that had about 5 ingredients. One, it talked to the term that those 3 companies would be able then to supply product into the country for a 9-month term on 6 months credit. 6 months credit, maybe what I could say there is that the open tender system allows for a 30-day LC to be opened by the seller into OTS, who's importing on behalf of the other buyers. The price of that LC is 1.2% of cost and freight, which we do include as a regulator in the price buildup. And this is one of the big departures between the G2G and the OTS, that we are now moving from a 30-day LC that is unwound after 30 days opened by the importer to a 180-day LC. The other provision of the master framework agreement is the quantities that shall be delivered into the country. And the third requirement is that the international oil company, because they're not ideally licensed to trade in Kenya, would have 2 options: either be licensed by us as the regulator to then do business in Kenya, or work through an agent or a nominee. And we left this to be at their discretion to then pick amongst those who are licensed by us as the regulator to then act as their agents for purposes of collection. Once we then had this agreement in place, we then went back and were able then to allow the oil marketing companies locally to be nominated by the IOC. The IOCs were to deliver product on a CIF basis in Mombasa, and there would be an all LC that will be opened, not by government, but by the nominated OMC, who would then be able then to open an LC in favor of the international oil company, and they would then supply the product through this nominated OMC. I think that's an important point to make, because there has been a notion that the government is then taking a risk or an obligation with respect to procuring this product. The government is just laying the parameters through this framework agreement, but still allowing the oil marketing companies, as it is the case in the open tender system, to continue to run this business through a market arrangement. Some of the questions has been, how will this work with respect to 2 things. One is liquidity risk and currency risk, because those are the 2 risks that are attendant in this transaction. One is the depreciation risk and the risk that the price at which you will then import products on month 1 may be different from the rate that you will then be unwinding at the end of the 180 days, and who takes that risk. We are of the view that once we get to day 180, we'll have had the opportunity for 2 things: that there had been a stability in terms of the international markets, and also the government working through the National Treasury and the Central Bank will have been able to stabilize the interbank market and would have seen a strengthening of the shilling. And with this strengthening of the shilling, we as the regulator at day 180 will be able to look at the rate at which the petroleum products were imported into the country in terms of the exchange rate, and the exchange rate at the time of unwinding the LC. And if there's a gain, and we do believe there will be a gain, then that will be passed on to Wanjiku at the pump. In terms of the liquidity risk, there is a liquidity risk that is attendant also, but we are also mitigating against this risk through the government by the National Treasury and the Central Bank working actively to shore up the foreign exchange reserves that Kwame has spoken to allow us then also to ensure that there is sufficient liquidity in the market to be able to settle the LCs at the time they do fall mature. Because you'd appreciate that today you'll be issuing a dollar-denominated LC as the oil marketing company against shilling collections from Kenyans in the pump. This is a significant risk, but is a risk that has been mitigated further by 30% of our demand. Between 30 to 40% of our demand is transit product. The requirement to pay now in Kenya shillings is for Kenyan product only. So when it comes to product that is in transit for DRC, for Eastern DRC, for Rwanda, for Burundi, for Uganda and South Sudan, those oil marketers lifting product for that region will continue to pay in could continue to pay in US dollar. And these US dollars will be sufficient, close to about $200 million on a monthly basis, which will still be sufficient to give us enough headroom so that then that risk does not crystallize. I just wanted to give that background to the transaction, Kwame, and hopefully maybe pause there. And I know there have been questions that have been in spaces such as yours, in the public domain through the media, but I wanted us to just have a conversation so that then I can be able to answer any queries, questions, or clarifications and spend a bit of more time there as opposed to this being a monologue. Over to you, Kwame.
All right. Thanks a lot. Thanks, Mr. Bagoria. Yes. Yeah. I don't know whether people have any questions. I'd like you to. Okay, there's some questions in the chat. I'll just for the guidance. We'll do this in two ways. If you have any questions, you may post them in the chat. But in the meantime, I'll try and ask. I'll try and allow for anybody who has questions. Please raise your hands as well, and then I'll point to you, and then you can ask a question to Mr. Bagoria. But let me start with this. So I think you've explained, yes, that the market arrangement has been maintained. One of the things that I was wondering about is basically, maybe you can clarify for us. So it's not a government to government. It's basically the government of Kenya and 3 corporations, 2 in the UAE and 1 in Saudi Arabia, which are state-owned corporations that sell or at least export petroleum. Is that the correct position?
Yeah, Kwame, it is a government by government to government because the thinking initially was to have this to be market driven, to open it up not only to government owned entities, but also to traders. You'll appreciate that our sector also has traders. You know, you have the Glencores, the Vitors, the Trafiguras, who are commercially driven. The reason that this was backed with a structure where you have an MOU signed between the 2 governments, and then the government's then allowing then a framework agreement that speaks to these 5 items, which are non-commercial in nature, to be signed between the ministry and the national company of that government, will lay the parameters then for a commercial agreement, which is a sale and purchase agreement between the IOC's nominee, who is a licensed oil marketing company in Kenya, and the IOC on the other end. So the commercial risk sits in the SPA. Because one way of doing this is, for instance, how it's done in Ethiopia, where the government issues a sovereign guarantee, that then this becomes a government transaction. But because of OTS and because of the policy imperative that this should continue to be a private market-led transaction, the government is offering a safety net. That there's an MOU between the 2 countries in form of cooperation. There's a framework agreement that talks to the duration of the contract, that speaks to the length of credit in terms of 180 days, speaks to the volumes and to the parameters of the transaction, but nothing beyond that when it comes to the commerciality. The commercial agreement is then left for the SPA between the oil marketing company and their nominee, the oil marketing company who's their nominee, and the international oil company. So what the government will then agree on is the parameters in terms of price, so that then we ensure that we are not taken advantage of unduly. And lastly is in the event that there is a default, and that's the challenge that we have, particularly with the traders, is in the event that there's a default or there's a potential default, it allows for the government to be able to step in. It allows for the minister responsible for petroleum in Kenya to be able to pick up a phone and call his counterpart and say, we're having a challenge in respect to 1, 2, 3, or even higher up with the leadership. And in the event, just to give an example, because traders will be looking at this commercially, if there's a better value proposition in another jurisdiction, they will then go there and you end up having to go and arbitrate on Fleet Street in London. And that is not a position that you want to be in. And that is why we took the view that we want to do this with the government, so that then there is a safety net with respect to ensuring security of supply. As I said, the primary reason is to ensure that there's security of supply. You don't want to be in a situation where there is no product, not only for Kenya, but for the region, because that can cause a bilateral diplomatic challenge as well.
Okay. That's understood. Now, and the second thing is, okay, so the government of Kenya sits back here, is not part of the commercial transactions, but obviously, as you said, I think it's superintending this as well, but also keeping contact with the other government to ensure that any creases are resolved. So what you're telling me is that it's the commercial entities that have skin in the game. Is there some insurance products to underwrite whatever the risks might lie, and where is that insurance product procured from?
We did review the regulation. Part of our mandate as a regulator is to develop regulations and advise the cabinet secretary on regulations that need to be entered into. We did amend 2 regulations. This is the petroleum pricing regulation and the import regulation in October and in January of this year. So it does introduce a duality in terms of government to government or OTS. The rest of the mechanics of supply of product into the country, other than the landed cost, the price computation remains the same. In the event that one of the suppliers is not able to perform, we're then able quickly to revert to the OTS because we plan on an M+2 basis. So we are planning for 2 months look ahead. So in the event that we are getting to a point where we don't have a nomination of a vessel that is going to load in a port, for instance, for Jaira, we then know that in the next 30 days, we are going to have a challenge with product, and we can quickly revert back from a legal standpoint back to OTS, which has just been mothballed, and call for a tender, what would ideally be an emergency tender, and to ensure that we continue to have security of supply. So we have a duality when it comes to G2G and OTS.
Okay. Now I see a couple of questions here, but let me just allow anybody who would like to ask some question. Please raise your hands before I read all these other questions. Please raise your hands, and my colleague Fiona will identify you, and then you can ask the questions directly to Mr. Bagoria. Anyone out here? All right. Looks like people are shy. So let me just ask the questions. Oh, someone's here. Okay, Kenneth Barasa, please go ahead. Kenneth, please ask your question.
Hello, people. My question is that I've posted it on the comment section. Now that we have realized that the arrangement is anchored mainly on credit arrangement. Now the question is, what makes it different from the former arrangement that we've been having as far as importation is concerned, or oil importation that is? What makes it very different? Because if it's still on credit, we have not been told on how we're going to pay the arrangements, you see? Because that's the same as borrowing money and going to buy, but now this one is taking it on debt. What makes it different from taking, for example, money from other counterparts and buying it elsewhere? What makes it different? That's the question.
All right, thanks.
Thank you.
And Mr. Bagoria, there's a second, maybe you can handle 2 questions at a go. Amboko Julians, please go ahead and ask your question.
Many thanks to the IEA for setting up this very important platform. Julian Samboko here from NTV Kenya. My question to the DG is this. Is there a hedging component in this arrangement? And why I ask that question is because if I'm a trader or I sit in the treasury of a bank and I know that 6 months down the line, this window for this G2G deal will have lapsed, there is no reason why I won't stockpile my dollars in anticipation of any market correction thereafter. So is there any hedging arrangement in this? Thank you.
Right. DG, you could go ahead with those questions.
Okay, thanks. I will start first by Mr. Baraza's question. Kenneth, I think the question as to what has changed, I think there are 3 things that have changed here. Is that in the current OTS, we procure on a spot basis, that we call for 8 tenders on a monthly basis, and where you could have 8 winners or 1 winner, or a range between 1 winner to 8 winners. So as opposed to spot tenders every month for 8 cargoes, we have gone and entered into term contracts for 9 months period with 3 IOCs. So that is one thing that has changed. The second thing that has changed is we are moving away from a 30-day LC to a 180-day LC. This is buying us a bigger runway, and this is also coupled with the third point on what has changed, which is the payment terms. In the current OTS, oil marketing companies who are buyers in the OTS are required to pay the importer, who's also an oil marketing company, within 5 days of discharge in Mombasa. So within 5 days, there is a mopping up of between $500 to $600 million in the market within those 5 days. So you have shillings chasing dollars within those 5 days. We are now changing so that then all the product that is destined for the Kenya market will be paid for in shillings on a pre-agreed exchange rate with us as the regulator. And as I said earlier on, we'll then look at the day 180 and see what the exchange rate at the time of invoicing the oil marketing companies is, and the exchange rate at the time of unwinding or at LC maturity, and see whether there's a gain or depreciation. In our view, there will be a gain of the shilling, and that benefit will pass on to Wanjiku at the pump. So that is the fundamental changes away from OTS proper to the G2G framework. I think in terms of Julian's question, in terms is there a hedge in this transaction, and wouldn't banks then sit and wait for day 180 so that then they can then be able to take advantage? I think the first step, the first message is really that there has been a challenge with respect to the interbank market. I knew last month it was only about 4% of our FX trading that was through the interbank market. The central bank is now working very hard to restore that interbank market. We're now doing about 10%, and hopefully about that will continue to increase. And we are seeing central bank also reflecting the true value of the exchange rate as they did a couple of weeks ago. I think that's the first step in terms of restoring the interbank. And will banks then wait for the market and wait to play the market in 180 days? I think not, because there are 2 or 3 interventions that is happening. One, central bank working to restore the interbank market. 2, the central bank also looking to shore up the reserves. And 3, the national government through the national treasury also working on bringing in additional liquidity into the market. So there is, through this framework, a risk management committee where we as a regulator sit, the government, and this is the national treasury, the ministry responsible for petroleum, will be able to sit and monitor and allow for the oil marketing companies to then approach the market and buy these dollars over time, so that then we don't leave it to day 180 when the LCs fall mature. We have to acknowledge also, Julians, that there has been some misbehavior, as it were, from a bank treasury standpoint, and we are of the view that if the national treasury, working with a sector-specific regulator, who is us at EPRA, and them as the financial services regulator work together, there will be no playing of the market, and a hedge is therefore not necessary at this juncture. Over to you, Kwame.
Okay. Thank you. There's a couple of other questions. I haven't seen any hands up, so I'll read the questions on their behalf. So there's a question, it's a common question by Brian and John, and many of them are concerned. John Mutua, my colleague, and there's Brian Ambani. I think the common question they're asking is, so what happens upon the expiry of the 6 months contract? I think this is one of the things that everybody seems to think, okay, so after 6 months, what happens? You could have alluded to that, but maybe you can make it clearer still. And we have Dominic Mirigi. It's the same concern about currency fluctuation. And he says, if the currency fluctuates greatly, what happens to the arrangement or the deal? And the second question is, what is the interest on that credit from the facilitators? Related to that, of course, is OPEC limiting production, hence affecting global oil prices. What do you think? How do you think this will affect this agreement? And then a final question from Givigi Ndegwa is sort of Dixon. So he says that where will the Kenya shillings generated by OMC be applied, appreciating that the amount could become large in the market in terms of liquidity? Okay, that's not very clear to me, but maybe you can go ahead, Mr. Magoria, go ahead.
Thank you. I think on the question, again, on what happens in terms of the depreciation risk, as I said earlier on, the risk of the shilling depreciating from where we sit is quite remote, and this is also, I think, the view of the National Treasury and the view of the central bank that the shilling is likely to strengthen, and there will be a gain that will be able to be applied at the pump. This is because of the interventions, as I said earlier on: one, restoring of the interbank market; two, is the central bank being actively in the market to show up reserves; and three, the National Treasury also actively engaging to be able to bring in more foreign exchange liquidity into the market. In terms of that risk, as I said earlier on, I just want to highlight out of the requirement of about $500 million, which ideally would leave this market within 5 days of being mopped up in the current OTS arrangement. In this arrangement, we'll be able to build up that liquidity in this market. We'll be able to build up liquidity in this market through two ways. One is the important component, which is a transit component, which accounts to about close to $200 million on a monthly basis. That will be offshored within 5 days. Will then sit in this market that will be able to collect dollars because, as I said, this arrangement to pay in shilling will be only for the Kenyan product. We'll be able to, it was only for the Kenyan product. The transit product will still be paid in dollar, but that dollar will then come and sit here for 6 months, and this also will improve liquidity. And how it will work is that these are rolling LCs, that the LC that is opened in month 1 will mature in month 7. The LC that opens in is opened in month 2 will mature in month 8, so that then it'll give us a lot of runway to be able then to approach the market and be able then to mop up the dollars in a more structured manner, as opposed to the rush over 5 days that has been obtaining today. I think the question also which has come is the issue of sustainability of this transaction. I think this is a transaction that we are looking to so that we can solve a macroeconomic problem. As I said, the petroleum products market and the OTS framework is a framework that has worked quite well, but we want to ensure that we have security of supply, because if we have shillings and we don't have dollars and we don't have access to the product, then we could have shortages. We want to ensure that we do have we do have sufficient product into the country so that then the economy can continue to be powered. After these 9 months, we'll be able to assess the market and see whether there are the pros and cons of progressing with this arrangement. As I've said, the regulation allows for a dual role between the OTS and the G2G that can be used interchangeably. I think the issue of the liquidity that will be generated, that will also be applied to the pump in terms of the investment of those funds that will be sitting in country, will also be applied with respect to this transaction to alleviating the pump price. I just want to say also what we have seen over the last couple of months in terms of the increase of the pump prices. Would attribute the increase in the pump prices to be more with respect to on account of depreciation of the Kenya shilling, as opposed to increase of pump prices internationally. So as you've seen a question with respect to the tightening up the market and cutting production, I think our biggest risk as a country is the depreciation of the shilling as opposed to the increase of the landed cost of petroleum products. Thank you, Kwame.
Right. Okay. Any other questions? Okay, Kenneth Barasa, you have your hand up, so you can ask again. Go ahead, Kenneth.
Hello, everyone. Mr. Daniel Kipto is using very heavy economic terms, as an economist or whatever he does. But I would like him to explain it on a layman language, because it makes no sense or any logic. You as a borrower, you are at the mercy of the person you're borrowing from. How can we dictate the value of the shilling when we are the people who are borrowing from the people who are actually using us as the market? How practicable is it for us to dictate the strength of our shilling in simple terms? Could you just explain that to us? Because I am seeing from my point of view, it makes no logical sense that this plan is actually sustainable. So maybe he could tell us how, as borrowers, because we are going on credit, how can we solve the fact that the shilling is losing the value against the dollars? Because it's the borrower who will always dictate the market. No, I mean the producer or the people who are selling. You see?
Thank you. Okay, fine. Let's wait for an answer for that. Let me see whether there's a second answer. There's a second question. Okay, there's a question from Stephen Jairo. He's asking that, noting that the largest component in the fuel price is the landed cost. In your view, what can be done to minimize or reduce it? Dominic Muridi asks a follow-up. If the oil shipment coming on the first of the month is due, is that really true? If the oil shipment coming on first month is due on month 7, I think if payment and so on, is there a concern that the due date will collide with the 2024 Eurobond payout? I don't know whether that's for Daniel to really answer. That's perhaps a question you should ask to the Treasury, but let's hear if he has any views on it. Go ahead, Daniel.
Thank you. I think the question from Dominic is more of a question particularly for the National Treasury, not even the central bank. But as I said, because we've been having these conversations jointly with them, as I said, I think they have several interventions in terms of shoring up our FX reserves as the central bank. There is also interventions with respect to bringing more liquidity into the market. So I think the question in terms of the maturity of the Eurobond in June next year is a concern for everyone, but I think that's more of a question for the National Treasury. For us, as we said, we're looking at $500 million a month, of which $200 million are coming from transit. Are we able to bridge the gap of $300 million? The answer is yes. And I think I want to put this together with Mr. Baraza's question, is that there isn't a borrower in this transaction. It's market driven. The oil marketing company is the LC applicant. They're the ones applying for the LC. They're the ones confirming the LC to the supplier, for the supplier to release product to come to Kenya, for them then to receive this product, to sell the oil market to the oil marketing companies, who are their fellow oil marketing companies. The oil marketing companies will pay them in shilling, and they will then convert this shilling to dollar in 180 days and make good their obligation. So government is not borrowing. And the question will just go back to the issue of forex depreciation, that you may be holding less shilling to then attract the number of dollars that you're looking for to be able to pay your obligation. And this is covered in terms of an FX risk, which is a pass-through. Same way that we do for power on a monthly basis as the regulator. But from where we sit, we see the shilling strengthening. As I said, it's a you are more conversant than I in terms of economics, and where you have removing a third of the demand of dollars from the market, from the Kenyan market, what that will do to the demand and supply economics, I think is for you to then tell. And the interventions that the government is then putting in place to ensure that there's more liquidity into the market, coupled with more regulatory oversight from a bank standpoint to ensure that the interbank market is restored, is what gives us confidence that that risk may not be able to crystallize. Thank you.
All right. Any other questions? Okay, let me see whether there's another question. So here we have a question stating that so from Degwa, right? Okay, I mean, he's asking the same question. Is there a possibility of forex loss? I think that has been handled by Mr. Bagoria. Any other questions? Fiona, do you have any questions?
Yeah, Kwame, there's a question we forgot by Leo Kemboi. Yes. What was the rationale for nomination of MCs in Kenya? And then I also have a question, because such government-to-government deals, I'm assuming there's a way that they result in some sort of lower prices because they end up reducing some sort of cost. I remember some time back just reading about David Diadin had done a tweet, and he was explaining how now, the OMCs were paying quite an amount for the demurrage charges. And then now, I guess now that will be kind of eliminated. So I'm wondering, when we were negotiating with the government in the Gulf, were we able to get better prices, some sort of discount or something? Yeah.
Right. Okay.
Thanks.
Daniel, go ahead.
Yeah. I think I'll start with Fiona's question in terms of business demurrage and whether we were able to negotiate and drive a hard bargain with a discount. We had a price discovery mechanism because we ran a competitive bid process first. And as I said, our intention was first to ensure that we have security of supply and we solve the macro problem. So our initial driver for this transaction was not to drive a lower price at the pump, but to ensure the security of supply and to solve this greater macroeconomic problem. When we ran a competitive bid process, this allowed us to have some price discovery. It was on that basis of those numbers that we're able to negotiate. And the answer is yes, we're able to negotiate from the prices that had come out of the competitive bid process, which we did for purposes of price discovery. The eventual numbers that we landed with were much lower than what had come out of the competitive process. So the answer to that is yes. In terms of demurrage, we'll be able to reduce demurrage in two ways. I think we have a cyclical problem because of the challenge of accessing dollars. We have product that is sitting in Kenya or sitting in the Kenya pipeline system or sitting outside our Kipevu oil terminal that is not able to come into the system on account of the oil marketers having collected shillings from us as Kenyans at the pump, not being able to convert those shillings to dollar to allow them to pay for the product so that they can access the product. That leads us to have a clogged system. This is coupled also with a challenge with respect to the government now being able to honor its obligations with respect to a subsidy payment. That has led to a clogging of the system. But with this arrangement, we'll be able to ensure that there's enough liquidity circulating to the economy and ensure that there's uplifts of product on a timely basis from the system so that then the Kenya pipeline system can be able to move more product. I think Kemboy's question on the rationale of nomination, I just want to say that typically an arrangement such as this is between one national company of a country to another. But the oil marketing companies, the international oil marketing companies, the IOCs that we're dealing with in this respect had a challenge dealing with our national oil company for reasons that may be obvious to some of you in terms of their ability to be able to open this LC on the basis of their balance sheet and also the track record with respect to them having been sellers into OTS. The international oil companies were of the view that we would not be able to impose a counterparty on them because it will be them taking a commercial risk against that counterparty. Because government has chosen not to be involved in this transaction by offering a sovereign guarantee or participating commercially in this transaction. So they needed to be comfortable on the counterparty that they are going then to engage with. Today we have about close to 90 active oil marketing companies licensed by us as the regulator, of which about 9 are the ones who are actively involved in importation of petroleum products into the country. They have a relationship with the suppliers in the Gulf. They have accounts with them. They have a relationship with them, and they are the ones who've been importing product on behalf of the rest of the OMCs into the country. So there is a relationship issue. There is a risk issue, and there's also an issue of the ability in terms of a balance sheet standpoint to be able then to open these LCs in favor of the supplier because there's a commercial risk. So that is how then we allowed the international oil company to pick their counterparty as long as they're able to perform and they're able to deliver product in tank in Mombasa at Kipevu. Thank you.
Right. I see that Barasa has his name, but let me allow one more person to a question. Gidigi Ndegwa asked this question. I think Mr. Bagore, you've answered it, but I think he probably wants to hear the answer in your voice again. So the question is, on the oil that is in transit through Kenya to other East African countries, which currency will it be paid in, and what's the time schedule? You stated that, but I think you just need to state it for the record for him.
Yes.
Go ahead.
Yes. Maybe I can go ahead. I think, Wanagirinji, the transit product will still be paid for in US dollar because we are solving for a Kenya problem, not for a regional problem. So they will continue to pay the dollar. And this is close to $200 million that on a monthly basis that I'm speaking to, that ideally would be offshored within 5 days of payment by the oil marketing company in the current OTS arrangement that we are now transitioning to from this month of April. Those dollars then will come from the region and they will then sit here in this market. And this will also help us ensuring our reserves as well and our liquidity, our FX liquidity in the country. Thank you.
All right. Barasa, you have a question. So if it's not a repeat question, let me first say, Osedo, let Osedo go first. Osedo, you have your hand up. Please ask your question. Turn on your mic and your camera if you may, and ask the question.
Thanks so much, Kwame, and good morning to everyone. So my question is very simple. I think one of the challenges or one of the reasons why we got into the G2G arrangement, apart from the dollar issue, was because of the high fuel prices in Kenya. So can Kenyans expect some price reduction with this arrangement over this period? And then the second part of it, I know fuel has a big effect on the power prices also in Kenya. So are we also, as Kenyans, expecting that the power prices would also go down? I think that's the question that every common person would be asking, apart from the dollar issue that we are facing as a country. Thanks.
All right. Thank you. Let me see if there's whether there's another question. Barasa, would you ask your question now?
Thank you so much. First of all, let me introduce myself. I am reporting from Human Rights as the youth officer from Bungoma County. Now, first of all, my first question is, now, will this plan go on after the 180 days? Because we need to stay afloat with the currency thing. Now they're talking about we need to bounce back our Kenyan shilling into strengthen our shilling. Then the second question is, now, what happened to the Turkana oil? No one is talking about that. Then about the refinery, is this fuel coming in fully refined, or do we have to refine it again? You know, because you are being told that refinery issues was costly, making the fuel expenses to go up. I would just like a clarification on that. That's all. Thank you.
All right, thanks. Mr. Bagore, before you answer, let me just ask one other question that someone is asking here from Dominic. So Dominic asks that I still don't get it. Why do we call it government-to-government action, but we still label it market-based? Yes, it is a government intervention. So please explain it again. I think it's what this tells us is that I mean, this is a complicated arrangement. I think that Kenyans need to understand more carefully, because it's both a financial transaction and an energy sector transaction, and that convergence is not always easy for everybody. So please just be patient with us and help Dominic to understand how it was arranged. Thank you very much.
Thank you. I think I will start with Dominic's question. Is this really a government to government? The answer is yes. Is because the premise of this transaction happening is an engagement between one government to the other, asking the other government that they would be able to work with us to deliver product into Kenya on a commercial basis, but be able then to influence the national oil company to work with Kenya to supply product into the country. If you are to look at this in terms of a risk profile of this transaction, and look at it and wear the hat of a commercial counterparty on the other side and say, would you enter into this arrangement based on the issues with respect to liquidity risk, country risk, forex depreciation risk, and also counterparty risk in terms of the oil marketing company, recognizing that the only collateral here, other than the LC, is the product that will be sitting in another country and in a system owned by Kenya Pipeline Company, which is 100% owned by a government. This is a transaction that you would enter into without significant safeguards, or even without a government sort of sovereign guarantee to give you assurance as a commercial counterparty. In my view, the answer would be no. And that is why this is a government-to-government arrangement. It needs to be overarched by an MOU, where the government say we shall cooperate with respect to energy in the country. You will then have a framework agreement that will lay the wide parameters, and then allow a sale and purchase agreement, which will be the commercial agreement between two commercial counterparties. And those three sort of layers is what then allows this transaction to then be underpinned. And that's the reason we see to be a government to government. And as I said, it affords the opportunity that in the event there are any commercial hitches or any logistical hitches, it allows for one government to speak to the other with respect to resolving those challenges, so that then it is not only a commercial outlet in terms of a dispute resolution, which can only either be resolved through the courts or through arbitration. That is why it's a government to government arrangement. Secondly, maybe going to Mr. Baraza's question from Bungoma on what will happen beyond the 180 days. The credit is for 180 days, but the term of the contract is 9 months. As I said, we'll play it by year because we're trying to solve this macro problem. When we get to close to the end of the 9 months, the regulation allows us to revert to OTS either before the 9 months in the event that there's non-performance, or after the 9 months to revert back to OTS. But this will be dependent largely on the success and the pros and cons of this transaction as we monitor it over month by month. There's a question around Turkana oil and where we are with that. As I said earlier on, as part of our mandate, one of our mandates is upstream regulation. This is a mandate that came to us with the passage of the Energy Act and the Petroleum Act of 2019. We are currently at the stage of reviewing the field development plan. Tullow Oils resubmitted their field development plan to us as the regulator. The law requires us as the regulator to be able to assess the technical and economical viability of the field development, after which we shall then recommend it to the Cabinet Secretary, and the Cabinet Secretary, if satisfied, will then approve the FDP and send it off to Parliament for ratification. So we're actually reviewing the FDP, which was resubmitted to us by the Kenya joint venture in the course of the month of March. Hopefully by June, we should be able to be coming to the public with our views on the field development plan as to whether this is commercially viable or not. In terms of the refinery and the question as to whether the product is coming refined or in crude oil form, it is coming in a refined product form ready for use into the country, similar to what the arrangement that we have today in the open tender system. The refinery that we do have has not been operational from the back end of 2012 into 2013. And this was on account of the inefficiencies of the refinery. It was cheaper to bring product out of the Middle East or even from India and land it cheaper than what we were having, cheaper than what were coming out of the refinery gate. Just for the benefit of this discussion, the margin that we had as Kenyans to support the product, which is about 30% of our global demand as a country, in terms of pricing, was about 1 shilling and 98 cents per litre, which was an additional premium that we had to pay to support the refinery on account of that inefficiency. I think lastly, Mr. Osedo had asked a question on the high fuel prices as to whether through this arrangement we will see a reduction in the prices. I again want to go back to the issue of security of supply. The main drive of doing this transaction was to ensure that we continue to have security of supply, that we continue to have fuel in our tanks as a country, and through ensuring that there is available liquidity of dollar to ensure that we get the product. So the main driver was not initially to lower prices, but through the negotiation of the prices, we shall continue to monitor the biggest component, which is the landed cost of petroleum products, to ensure that we're able to introduce efficiencies through reducing of demurrage, efficiency in the transportation through Kenya Pipeline, to ensure that any benefit that will accrue from this transaction and from the international market will be able to be passed on to Wanjiku. In terms of the power prices, again, which is also within our mandate, we have seen the rains come. We have had a significant challenge, and maybe just to give some numbers, in the month of March, 45% of our power generation came from geothermal. Hydro only gave us 11%. This is because of the reduced hydrology. This was even surpassed by wind. Wind was 13% of our energy mix last month, and we had thermals giving us 15%. You can see the thermal number. Our industry target is to have a thermal dispatch to not exceed 5% on a month by month, but last month it was giving us 15%. This is because our dams were quite low with water. We've now seen the short rains come, but the long rains come, but the rains have been short in terms of duration. So we're continuing to monitor our dam levels, and we hope that the rains continue to pour, because that will allow us to then increase our hydro generation to then support our geothermal, and this will allow us also to reduce our thermal. But we are monitoring this, and I think the Kenyans' expectation is that, sometimes it rains today and we expect a reduction tomorrow, and these dams take a significant volume of water, and they do take time for them to be able to fill up. So we'll continue to do our bit as the regulator to ensure that we keep the utility and we keep the other entities that are playing this sector on the straight and narrow, and any benefits that then accrue are passed on to Wanjiku, either in the form of power pricing or fuel pricing. Thank you, Kwame.
All right. Thank you very much. There's one more question. No, Kenneth, I mean, that's just a comment Okay, can I have any final comments? Yes, someone has a hand up. Let me see who. Okay, Dominic, you have your hand up. Please ask your question. Just turn on your mic and ask your question. Dominic? Dominic, your hand is up. Please ask your question. Okay, we'll go ahead. I think we'll. So Martin says on the commentary that the main aspect of this arrangement is basically security of supply rather than the competitive pricing aspect. So wouldn't still this arrangement work with the current global traders having already established relationships here? So you say, Martin says there's a bit of a gray area with regards to this arrangement. Then there's Ben. Ben, do you want to ask your question? Please turn on your microphone and ask your question. Ben.
Yeah, mine is just to ask Daniel, is there any country that has a success model of the same so that we can benchmark with the same and know if it has really worked with other countries? Maybe it is a trial version in Kenya.
Right, thanks.
Thank you.
Okay. Daniel, go ahead.
Yes, I think I'll start with Ben's question. And yes, every country is looking at ensuring that they have security of supply. And I think the biggest question here has been energy security. One of the bigger issues, as you can note from our sector, the last couple of years has been decarbonization, has been conversations around moving to renewable energy and green, the conversations at COP26, COP27, the Paris Agreement. But with this Russia-Ukraine crisis, the biggest challenge for regulators, the biggest challenge for governments is security of supply. In terms of what other countries have done, I was last week in Ghana. If you look at Ghana, they're in a program called Gold for Oil. There you have natural resources. They're able to trade off their gold in exchange for oil and petroleum products. That is what they are doing there. We have taken time as Kenya from September last year to come up with this transaction. When our neighbors in Tanzania saw what we were doing, they've also picked it up from us. The Indians are also in another similar arrangement. They're engaging with the Iranians, they're engaging with the Russians, they're off-taking Russian product against the charging of the US. There's conversations between UAE, the Saudis, the Chinese in terms of payment in other currencies. They are paying in ruble, Russian ruble, they're paying in yuan. So I think the point I'm trying to make here is every country is trying to see how they can be able to best ensure and safeguard their security of supply in the best way they know how. And this is what we are trying to do as a regulator, working with the government to ensure that also we ensure that the security of supply for the country. Because I think the most important thing first is security of supply, ensure that we have fuel in our tanks, to ensure that we have our lights on. So each country is trying to look at their strengths. As I said, for instance, the Indians are continuing to lap up all the Russian product that they can get. There's a price cap from the US. The Indians opening, defying that. Are we able to do that ourselves? That goes back to the question of global geopolitics and our standing also in the pecking order at a global level. So every country is trying to do what they can to ensure that the security of supply. We are trying to do what we know best, and hopefully we'll be able then to achieve it for the country. I think that was the question. I don't know if I've missed on one. Kwame?
Yes, there's one more from Dominic.
Yes.
Mike has a problem.
Yeah.
He says that, so this is a different segues into the hydropower. Do we have any closed loop hydropower plants, or do we have any plans for one? I understand that closed loop hydro plants have a better success than on-river hydro plants like we have in Kenya. And he says there's a case study in India. So guys, let me, as Daniel answers this question, please ask you to prepare your final questions, because after this, we'll just ask him to make final comments, and then my colleague Fiona will close the meeting, because we have promised to have the meeting done by 11:20. So go ahead, Daniel.
Yes, I think on hydro, this is part of the climate change conversation in terms of construction of dams. There's a couple of dams. There is a dam being mooted by Kenyan, called the Karura Dam. There's also the High Grand Falls Dam, which is a multi-purpose dam. multi-purpose because it's used for irrigation, for water supply, and also for electricity generation. From where we sit ourselves, it is important that we continue investing in dams so then we can be able to show up our catchment in terms of hydro. We still have a lot of geothermal potential, the 10,000 megawatts and beyond, which we need to be able to exploit as a country. But the challenge with hydro, as you've seen over the last couple of years with our failed rains, is having dams that are constructed, but they don't have any water. So we need to have a sustainable energy mix that has a balance so that then we're able to deal with the vagaries of climate change when they hit us. In terms of the investment and the high capex investment of those hydro plants is also something that needs to be thought about. And we see whether our best resources could be better, our resources are best deployed in hydropower projects and how we strike the balance between that and other renewable energy sources such as wind, solar, and geothermal, which we have in abundance. I think that's a conversation for another day.
All right, I haven't seen any other questions. So what I'll do is do you have any final comments, Daniel? Then I'll pass over to my colleague, Fiona, to close the meeting. Do you have any final comments?
I think for me, just thank you, Kwame, for setting this up, and we're happy to continue engaging with you. As I said, being the regulator, we regulate both the technical and economic side of things. We also have a mandate to then advise the policymakers, which we actually do. And we just want to thank everybody who's made the call here today. I can see the civil society, there is industry experts. We have the Fourth Estate as well present here. We want you to be our advocates, so to speak, and to preach the gospel, as it were, in terms of the conversation that we've just had. So then we can be able to educate and inform the public on the interventions that we're undertaking, so that then people are better informed and they're able then to take a position on these matters from an informed standpoint. Thank you.
All right. A final question came in, but Fiona, you make the choice about whether to ask that final question, and then you can summarize the meeting and then close and thank Daniel for a fantastic presentation and for being accessible, which is a rare thing for people in your position. So thanks a lot for encouraging us and for being here. So Fiona.
Thanks, Kwame. So I can see Osedo is asking about IPPs. I don't know, DJ, would you take the question or we put it in another webinar?
No, I think I can take it quite quickly because the question is whether we have a role in regulating IPPs. The answer is yes, that any agreement for the sale of electrical energy, for it to be effective, must have a regulatory approval. So any agreement between an independent power producer or KenGen will have to come to us for approval. They usually long-term contracts, and then the answer to that is yes. And we regulate not only the tariff, but also technically we conduct audits. We follow up on the activities from a technical engineering standpoint as well. Thanks.
Thank you. Sedo, I hope your question is answered. All right. So on behalf of the IEA and also all the participants that are here with us today, I would just like to express my gratitude and appreciation to you. Thank you so much for taking your time, for even just trying to make this a bit easier for us. It's been an entire discussion everywhere. Like, people have been trying to understand what exactly is this deal about. So thank you so much for coming. We have at the IEA, we have 6 programs actually. So the guys who are hosting this webinar today is the Economic Competition and Regulation Program. So we look into matters of petroleum, electricity, etc. And then we have the PFM, which is the Public Finance Management. We have the Popular Economic Program. We have the Competition Law in Economics. We have Trade and Development. And then lastly, we have the Futures and Foresight Program. So for anyone who's joined us today, who's not a member, you can also be a member of the IEA to also be able to tune in for such engagement. So thank you so much, Director General. It was a pleasure having you today. Thanks.